Welcome to Making Money. I'm Matt McCall. It is the first day of February. That's a good thing for many reasons. It's a nice, short, sweet, to the point month. It's my birthday month. And it gets us out of January, which was one of the worst for the stock market to kick off the new year in a very long time. The Nasdaq was able to rally yesterday to end the month to avoid the worst January ever in 50 years of existence of that index. We're going to talk about all that and more, but today's a special show. I have a presentation I put together for you talking about why I think right now is such a great buying opportunity. I'm going to show you stats that you never heard of. This is a must watch, folks. This is something that I'm giving away for free, and I put a lot of work into this. It's something you need to tune into and share with your friends because this is the truth. We're getting through the BS and we're getting down to the real numbers. All coming up right now on Making Money. Again, folks, thanks for joining me. I am Matt McCall, and it's great to be here. You know, it's February. It's always great to be here anytime, but I have a really special show for you coming up today, and I'm psyched. I just can't wait to do it. So I want to jump in right away to look at the market and look at the charts here. We're looking right now. We'll pull up the S&P 500 chart, symbol SPY. You can see here, we're about an hour into trading this morning on Tuesday. It's down about 0.1%. So trading, kind of right where we closed yesterday. But you can see the big rally that we've had the last two trading sessions. Two of the biggest days that we've seen really since this pandemic happened, and we had the initial rally after that. So we've seen a lot of money come into the market. I'm going to talk about that here in a minute with our presentation I put together for you over the weekend, which again I think is just it's going to really hit home with a lot of people and kind of explain things for you. But as you can see, we're a bit of a bounce back, very similar with the Nasdaq, almost the exact same chart. We've seen here two big days on the upside. I will mention one thing I think is kind of fascinating, and this is the ARK ETF, ARKK, ARK Innovation. I talk about this all the time, and it's basically unchanged today, down 2 cents. But right back here, I don't want to use any negative word, some talking head on television, you all know and we've seen for many years, came out and basically made fun of the ARK ETF and just poured all kinds of scotch over it. I mean, just acting like an imbecile, honestly. I mean, just like making light of people losing money is insane to me. I mean, that's the whole point of what we do. It's a media thing, but we're here to help you make money and help you achieve goals you're trying to achieve in your financial future. It's BS that somebody that they joke about that, and I didn't have respect for the guy prior, and I have zero respect for him now. I think he should be taken off the air because I mean, the fact you're making fun of individual people losing money is just absolutely just shows the epitome of just how this rich guy thinks. So anyway, I like to see it bouncing back. And on that, I will, full disclosure, I did buy some ARK on Friday at $67 even. I'm still holding on because for me, I can't buy the stocks that we recommend to our subscribers. So an ETF, and I saw it was basically an anti this guy trade. And so I wanted to talk about it and put my money where my mouth is because I'm going against him. And so far, so good. It's up, $8.50 or so. All right, so I want to get right into this, though, because I think it's really important that we dive into it. So here we go. Let's go through this presentation. This is as if I'm giving a presentation in front of thousands of people right now, but I put this together the weekend to help my team, to help other people in the company, help friends and family, and then, of course, help all the tens of thousands of people that watch the podcast as well. So as you can see here, the first slide says there's reasons to be bullish. And I'm going to go through these in detail in a minute, but let's just go through them quickly. We now have magazine covers that have bulls stuck in a snowstorm. I'll show you that picture in a minute. So my point is, when you start seeing magazine covers and websites extremely bearish, it's usually a good sign for the market to go higher. Last week, we had the put-call ratio at historic highs. And that means a lot of people are buying puts. And buying puts, that means you're bearish on the market, you're buying insurance. Again, a contrarian view tells you you're near low. The AAII, which is the American Association of Individual Investors, last week came out. The bears were at 52.9%. That's the highest level we've had for bears since 2013. Again, contrarian view. The VIX, the CBOE Volatility Index, spiked to a one-year high last week. Again, they usually say when the VIX is low, it's time to go. VIX is high, it's time to buy. That's a good thing for stocks in the short term. About 40% of all Nasdaq stocks are down at least 50%. I'll dive into that more. We've seen the largest pullback ever in the XBI, the Biotech Index, actually hit a new low. So that's really important, or not a new low, hit the biggest pullback ever from a high. Unemployment rate, though, let's talk about some good things. Unemployment rate's at 3.9%. Corporate earnings remain strong. COVID cases falling quickly. So we have a lot of contrarian things telling us things are good, and we also have some good news out there as well. So let's jump in. This is Bloomberg Business Week. It's the big chill. Investors are bracing for more pain as a cold snap descends on the market. These are the times when you see this, I'm like, man, we got to get out there and buy. It's the fear in the media that you see. And I could have put 10 of these different pictures and headlines out there because they're just so damn negative. It's unbelievable. So corrections, folks, are when the market pulls back between 10 and 20%, or at least 10%, let's call it. And you can see here, this is from LPL Research going back to 1950. Since that time, on average, we have one a year. So you have one correction a year in the S&P 500. We didn't have one last year. We obviously have one right now. We hit correction territory last week on the S&P 500 and on the Nasdaq. So it's not abnormal to see corrections. So again, we're seeing this. And I've been saying this for a while. When I put together my 2022 outlook, I wrote in there that there's a good probability that we're going to have at least two corrections. And we're in January, we have one. So I think we're going to see a lot of volatility. I think there's going to be a lot of great buying opportunities, but I think we could very potentially see another correction depending on what the Fed does. But yeah, I just wanted to show you that this is not abnormal. These things happen often. So this is a great stat I found. This was from Dow Jones Market Data. It's the Nasdaq after a correction. And you can see over here on the left, this goes back to 2007. And after the Nasdaq goes into correction territory, how the market does. And as you can see, for the most part, we have a lot of green. And here's the average and the medians over here. So 1 week later, it's up. 2 weeks later, it's mixed. 3 weeks later, it's mixed. 1 month later, up and flat. 3 months, 6 months, 1 year. My point is, you look at I don't care about weeks out, months out. I'm looking several years out, but 1 year is a good number. And you can see the median gain after the Nasdaq goes in corrections right around 20%. So that's well above the average gain of any other rolling 12 months, the average rolling 12 months of the Nasdaq. So it actually does better than the average 12-month period, rolling 12-month period. So I think that's fascinating that, a lot of times when things go into a correction, we panic when in reality we should be looking for opportunity. This is fascinating because with the Nasdaq down about 12% or so right now from an all-time high, 10 and 12%, somewhere around there, it's like, well, it's not that bad. But the average stock in the Nasdaq is down, this was as of a few days ago, folks, 43.6%. 43.6%. And look at this. I mean, here are the numbers right here. The S&P, this was, again, last week, it was down 7%. Average stock was down 15.5%. Nasdaq 100. So this is the 100 largest stocks in the Nasdaq composite, ex financials. And the reason that it's not down as big, and especially right here, this number, the average, is because it's got Apple, it's got some of the big names in there have held up a little bit better, so the average isn't down as much. Whereas the Nasdaq composite I showed you, and then the Russell 2000 small mid cap, down nearly 20% in nearly a bear market overall, and then the average stock's down about 38%. And then out of the ACWI, it's just an index of global stocks, about 1,288 of them are now in a bear market, which of course is 20% or more down. And there's a Nasdaq again, 2,600 and change at a 3682 in bear market. 1,760 Nasdaq stocks are down more than 50%. So that equates to about 45% of all Nasdaq stocks have lost half of their value. So again, the headline numbers may not look crazy, it may not look overly bearish, but we're in a bear market within a market right now, especially when it comes to technology and innovation. It's truly a bear market. So this shows the percentage of number of Nasdaq stocks down at least 50%. It's at its highest level, folks, since 2008. So we know what happened 2008, 2009. March 2009, the market bottom ended up being one of the greatest buying opportunities of our lifetime. And now we're seeing the number of Nasdaq stocks down at least 50% higher than when we had that little mini crash after the pandemic in early 2020. That is amazing to me. That just shows, again, the amount of weakness within that index. I mean, we've flushed out already. It's not like, oh, we need more downside. We've flushed these stocks out. Again, this is a contrarian view. And you look back when we spiked to these levels, huge market buying opportunity, huge market buying opportunity. We saw one here in 2002, same thing, rally from there. So you're going to see the history shows that it's actually a really good thing. So here's stocks after a correction. They tend to do well. This is from LPL as well. This goes back to 1980, and it shows how much the correction actually ended up being. And these corrections actually take into consideration corrections that turned into bear markets as well. So that's why you see the median 16.5%. And then you see the 1-year return after the lows, median gain 25.9, and it's up 90% of the time. So you get a 9 in 10 chance. I mean, that's a really good sign. And then over here, 2 years later, you have about an 87% chance with a median gain of 45.2%. It's not like I'm spinning this in any direction. These are just when you go into a correction, what happens. It ends up being typically a great buying opportunity. Now, buying the correction. I got this from Goldman Sachs. I thought this was a pretty cool chart. It says if you went into the S&P 500 since 1950 and you bought the moment it went into a correction, so the moment it hit a 10% pullback, you don't know it could continue to fall more. But you did that and you held on for 1 month, you'd be up about 2% after that, even though sometimes it could keep going lower. 3 months, 3%, 6 months, 6%, and 12 months, 15%. The numbers over here is if you just buy unconditional, not just buying any time, looking out. So the average gain over 12 months, 10%. So again, this is buying when it's down 10%. You don't know that it's not going to go down an average, as I just mentioned, 16 and change. So you actually may be buying a little early. But it's just saying, because it's so tough to time the market, if you buy into corrections into the index here, and even let's take a step further, if you're buying into a correction outside of the index and trying to pick quality companies that are down even more, I think even have more upside potential. So again, a chart that just shows you buying the dips works. And this is over the last 71 years, folks. So this is I threw it out there. It talks about fast corrections that happen really quickly, days to a 10% correction. You can see, obviously, it took only 6 days, fastest correction ever when we go back to COVID, because obviously that was a black swan event that caught the market off guard. But this one is pretty damn short too, 14. I mean, the only other one that was shorter was 2018, and then going all the way back to 55. So you can see 3 months later, up every time. 6 months later, up every time. 12 months, not every time. It was actually down to 2000 when it was down 12%. But again, the median gain, 7.6 in 3 months, 16.8 in 6 months, up 100% of the time, going back to 55. And then again, 12 months later, median gain, 18.1%, well above the market average, positive 83.3% of the time. So there is precedent, again, to buy into corrections, especially quick ones like this, because it comes back just as fast. I love this chart. I love showing people this, any investors who maybe think the stock market is too volatile, whatever it might be, who sell into every sell-off and panic. So this just shows that volatility is normal, and this is from FactSet. And as you can see here, this is every year going back to 1980. And down here, these numbers are the max drawdown from the high of that year to the biggest pullback that we've had, from high to low. So last year was a bit of an anomaly, only down 5%. Year before was 34, that was 2020. Obviously, that's when we had COVID hit. Year before was 7. Year before that was 20. But you can see, it's on average, you're going to have double digits. It's going to be in the double digits drawdown. So that means that's why you have an annual correction, based on the averages. But what I love about this is, look at these bars. Since 1980, there's not a lot of big bars down here. I mean, you take away 2008, which is the financial crisis. You take away, I guess that's 2001, was obviously the tech bubble, down 23%. The worst annual, this is where you end the year, the worst annual return was negative 13%. Yeah, that sucks. It didn't go higher. But again, you look at all these big gains. Look at this, how many times the market's up. And that's very important to take in consideration. The odds are the market will be higher, especially over time. And you look at all these pullbacks and they still end up higher. All these drawbacks and it still ends up higher. I love this chart. Look at this when you panic, because this, again, just shows you pullbacks are normal, folks. So the VIX spiked last week. And when the VIX spikes, stocks tend to be higher in the future. And you can take a look here from actually it was 2 weeks ago, I'll take that back. From the 14th to the 21st of January, we had the VIX in 1 week spike 50%. And it was one of the bigger ones. You can see there's been bigger ones, obviously. 2020, this was the pandemic. That's the biggest one. And then a few other times along there. But what I love about this is that out of the 20 times that the VIX has done this, and again, this goes back to 1990, but 94 is the one, latest one in there. But it goes back to 1990 again. So we're looking at 31 years of data. That going forward, 1 week, 1 month, 3 months, 6 months, 9 months, 1 year, the average is positive every single time frame. Because when a VIX is high, it's time to buy. Those spikes typically are led by buying opportunities or followed by buying opportunities. Again, folks, I'm just taking all kinds of data and putting it together because I over the weekend, I analyzed corrections. And I've done this many times in my 20 plus year career. I have so much data on this, and I try to get new updated data as we go along. So this is fascinating. Mark Holbert, he used to work for Market Watch. I don't know if he does anymore or does his own thing, but he looks at newsletter people like myself, and he rates them, and then he'll go through the newsletters and say who's bearish, who's bullish. But I like about this is, at the March 2020 bottom, this is the average recommended stock market exposure among short-term Nasdaq-focused market timers. I don't know what that even means, but these are guys that focus on the Nasdaq. We can see how this is a percentage over here, negative percentage. Basically, they're short. And what happened there? Bottoms of the market. Look where we are now. So basically, what this tells me, in simple English, is the newsletter guys are throwing in the towel. They're getting so bearish, and you're seeing when that happens, typically again a great buying opportunity. I just want to throw this in here because this is the XBI, the S&P Biotech ETF. XBI is a symbol. And I looked at the drawdowns we've had over the years. And you look at this. This is the biggest drawdown we've ever had in biotech stocks. I love biotech stocks right here. And I'm probably going to nibble on a little bit this week. I just think there's huge opportunity. I think they've just been decimated. Were they a little bit ahead of themselves? Sure. You could say that. Do they typically struggle when interest rates spike? Yeah. But they're not going to spike, and they're going higher, but we're still at 1.8% on 10-year. 1.8%. Before the pandemic, we're about 1.7. So we just got back to where we were. We have the economy booming. We have core profits at the highest level ever. So they go up a little bit. And the thing is with the Fed, folks, the Fed, they said what they're going to do. Where's the risk? Sure, when the Fed raises rates for the first time in March, you might have a little bit. If they do 50 basis points, maybe a bit of a shock, but I don't think they do that. We're pricing in, this pullback's pricing in Fed rate hikes. That's what people understand. When it actually happens, we know that. The market's not dumb. We've priced it in. It's not efficient because there's still people doing the opposite, but you have to realize we priced this in. When it comes to biotech stocks here, we've priced in the worst. Such opportunity. And again, I just want to show here, this is just sort of last year, how this is the S&P 500 up there. And then you have negative is the Russell 2000 small mid cap and then the micro caps. Small caps have greatly outperformed in just 1 year. I mean, the performance, nearly 30% difference between the S&P 500 and the micro caps. I see great opportunity because it doesn't last this long that there's this huge divergence. It comes back together. And for that to happen, these guys down here, the small guys, have to do well. It's a midterm election year. So what this shows here is from LPO. It shows the intra-year decline. Typically, there's a lot of swings. So again, this is not abnormal for this type of year to have bigger drawbacks than normal. However, what does this show? The returns 1 year later. Look at these spikes. This is 40% here, a couple over 40%. How many over 20%? Again, buy into the dips, folks. It's very simple. I can't say this more. So rate hikes are not to be feared. And you can see here, these are years going back to 1970. Again, from LPO, those guys over there are great, and gals. Since 1970, when we've had multiple rate hikes in 1 year. These are at least 4 times in this list. And you can see the S&P index, the yearly change in those years, not great because there's a couple of big down years there, but the average is 3.5, median 2.5%. My point is, again, I think that we've priced in this pullback already, that from this level, to get back to even have a 3.5% gain for the year, you're going to have double-digit gains from here because you need to get back to where we were just we're at the beginning of the year. So I'm just throwing out there to show you that you don't have to fear it. It's not like, oh my God, the world's over. We've never seen interest rates go up before. It's happened a lot. Again, this is kind of a random one, but this is CapEx spending, capital expenditures spending. This is manufacturers' new orders, non-defense, because it's not like the Boeings and the Raytheons and stuff in the world, but no aircraft in there. But look at this. We obviously were going really well, and then we dipped because of the pandemic. We went into recession, and look, companies are spending on capital expenditures. But why, you ask? Well, because the economy's good, demand's there. People have jobs, unemployment rate's low, wages are going higher. And again, every time I say this, people get pissed at me because they know somebody or themselves that doesn't have a job and they're not getting paid enough. And I get that. Most people, I don't think I get paid enough. I think I should be paid more too, and I make a pretty damn good salary. But I think I should be paid more, and we should think we get paid more. But listen, my point is, this shows you what's going on. The companies, they're doing that because they're also setting up for the future. You would not be putting so much money into capital expenditures if you thought the market was going, or the economy is going through a deep recession. You wouldn't be doing that. These people aren't stupid. This is a great chart too. You know, why you buy and why you don't pull back, or why you don't panic on every pullback. So this shows if you buy into the market, the S&P 500 going back to 1928, so over 90 years. And you look at it and it shows your holding period. And you can see here, if you hold for 1 year, you got a 75% chance of going up. You go a little bit further, 5 years, you have an 88% chance. You go to 10, you're at 93. 93% is a pretty good percentage. So I always say, you know, looking out 3 to 7 years, 5 to 7 years, depending on what I say. So we're going to put it right in the middle here. So you're looking at that 7 year about 90%. So you get about a 9 in 10 chance the market's going to be up. Again, if you're picking quality companies in mega trends that have very high odds of disrupting old trends and becoming the next leaders, your odds are probably even higher. Again, you have to think about timing the market, not trying to time it. Even though I've been talking about timing buying pullbacks, but you still have to wait after buying that pullback in the market. And I just thought this was funny. I put this in there. This is where I feel we are with a lot of our mega trends right now. A lot of people think our mega trends are dead. This was from the Daily Mail, December 5th, 2000. Internet may be just a passing fad as millions give up on it. Well, we know how that ended. Yeah, I mean, that's, folks, I mean, I'll tell you, when I look at these numbers, and I spent, you know, the last week or so over the weekend putting these together, and I'm a student of the market. I'm a historian of the market. So I try to see what happens in past times. And again, not every time is going to be the same. You know, we didn't have the internet 40 years ago. So it's going to be a little bit different, right? Or at least it wasn't widely used. And we have much different access. You're not hitting and click to buy and sell. You had to call your broker on the phone. Much different life. All that being said, folks, we are still the same as far as emotions are concerned. Our emotions drive the panic. Our emotions drive the greed, which is now called the day and age FOMO, fear of missing out. So that is driven by our brains, which haven't evolved that much since the caveman. It's evolved a bit, don't get me wrong, but there's a reason we like negativity. There's a reason we have fight or flight, because that woolly mammoth was coming after us and we had to be alert at all times. It's still in our brains. We're still very much as we were thousands of years ago. So nothing's going to change between now and 30 years from now or 100 years from now. It's still going to be driven on emotion. And as human beings, we make some really good decisions, some really poor decisions. Typically, if they're based off emotions, they're going to be poor. And that's what drives you to sell at the bottom, buy at the top. Again, folks, I just want you to know that this type of environment is normal. This type of environment is an opportunity. And this type of environment creates very successful investors. And again, remember the crux of this show. The crux of this show is to educate you, have fun, and make some damn money. And I hope that's what we came through today in today's show. So I want to thank you very much. Comments, questions, let me know if you like this presentation style. I'll put some more together for you throughout the coming months. But again, thank you so much for watching. Stay steady. It's okay. Things are going to turn around. Again, thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.